Okay, I'm going to go ahead and start with a little bit of historical data to sort of set the context for what's been going on, or what's been going on the last few years to set the context for what we're seeing today. And the energy industry has, of course, been notoriously cyclical, but we think the situation today is quite a bit different from what it was 10 years ago or so. Before the shale opportunity began taking off, the majors and the international oil companies had been divesting their North American assets to the smaller, more nimble independents who would wring out the last bits of hydrocarbons in a declining market. The mindset at the time was that we were building LNG import terminals to address the coming domestic gas supply shortage. That situation has totally changed. The shale opportunity has caused the majors and the NOCs to make very long-term, very large investments in North America, and we're now building LNG export capacity. This page shows North American E&P acquisitions and joint ventures by the IOCs and the NOCs in recent years. And if you went back a few years before this, it would tell a similar story. But as you can see, the total acquisition spending from just these large companies was $176 billion over the 6 years ending 2014, and joint ventures totaled about $53 billion. These are big numbers. And in this next page, I try to put that in perspective. This page compares the $229 billion that we saw on the previous page to the aggregate market caps of the big four service and equipment companies and the aggregate market caps of the 9 largest independent E&P companies at 4 different points in time. You can see there, $229 billion. This is just acquisitions by the majors over the last 5 years compared to these. And you can see here, the blue, it represents Baker Hughes, Halliburton, Schlumberger, and Weatherford. The gray represents Anadarko, Apache, Chesapeake, Continental, Devon, and Encana, EOG, Noble Energy, and Pioneer. Just trying to put that investment by the majors in perspective. The previous page focused just on acquisitions by the IOCs and NOCs. This chart on the left, drilling and completion spending, is a much better way to show the growth in North American activity driven by shale plays. And this page shows, since 2003, the amount of spending. We estimated, based on the rig count for targeting oil versus targeting gas, the spending targeting oil versus gas here. And what really struck out to me was the amount of oil-directed spending occurring in the last 4 or 5 years. A truly amazing ramp-up in spending in the big key oil plays, the Bakken, the Permian, and the Eagle Ford. In the right side of this page, try to put that in context. This is one number that really struck me is, if you look at the average drilling and completion spending from 95 to 2002, really before that shale period, $18 billion compared to the 1 year 2014 of 164. So it is a dramatically different market. And I just thought, just for fun, trying to put this again in context, global cinema spending, $39 billion per year. North American sports sponsorship spending, about $10 billion a year. So these are big numbers. This page, all of this growth has required a ton of capital, and what we show here is U.S. debt and equity issuances. This is just energy services and equipment companies since 2004. The debt numbers might seem large relative to equity, but keep in mind a lot of this debt was issued to take out other debt. Also, most of the energy service and equipment companies during this time period were generating a ton of cash, reducing the amount of outside capital required. But one point I'd highlight here is look at the total equity offerings since 2010 was about $9 billion, which is a relatively small amount compared to the numbers we saw on the previous pages. Keep this $9 billion in mind, too, as we go to the next chart. This is one of the key trends we've been seeing in recent years is the rise of private equity focused on energy. And the total private equity energy funds raised just since 2010, the last 5 years, by our calculations, about $88 billion. This compares to $8 billion of total public offerings, IPOs and follow-ons for the energy services and equipment sector. Now, I would point out that this is all of energy, not just services and equipment, but it does highlight the fact there's a ton of capital out there targeting energy. And on the right, we show some of the funds that are making or have been raising those funds. The chart on the left shows the current PE investments by investment date. This is a distribution of the current investments based on when the investments were made. You can see there the average holding period about 3.7 years, 500 PE owned energy service and equipment companies by our calculation, and this consists of about 200 PE firms. The totals on those charts don't add up to 500. It's a little bit less. Some are earlier vintage, and some of them we did not include because we didn't know the investment date. And then on the right side of this page, we show in 2 points in time, 2011 and 2014, the percentage of the buyers out there who have been private equity. And I would point out this represents independent private equity investments, not investments by portfolio companies of PE firms. If we included a PE firm-backed service company that bought another one, that would increase the number on the right side here, 2014, to 55%, or more than half the market, PE-backed buyers. And in 2011, that 16% rises to 25%. The generalist PE firms have been active in the energy service and equipment markets in recent years. Most of these generalist firms, I would point out, though, have dedicated energy specialists, many of them with long tenures in the industry, especially the larger of these firms. So how has this shift towards private equity changed the market? I could spend a lot of time on this page, but the key points are there are a lot more exit options. Within this large universe of PE firms, you could segment them by size, by type of investments they're interested. Some are interested in technology, some are value-oriented. So if we're going to market a business, it's not just go out to all 200 of these private equity firms. You can create a good targeted list and capture a good broad list with interest in the sector in the type of business that we'd be marketing. Because there's so much capital and because there's very large funds, there's less of a need for IPOs. You don't see the companies getting to a point where they're big enough to be public, then going public. Often it means the transition to the next tier of private equity firm. And so you see fewer IPOs. And an increase in the number of larger private companies. There is a tremendous interest with all this capital out there in operating partners. If you're a good seasoned manager, you're in a great position these days. You're probably getting a lot of calls from PE or looking for good teams to back. With all this money, there's a tendency, because of their holding periods, to be more capital market sensitive and because of their involvement in the capital markets. So we see the whole market reacting more quickly when interest rates go up or down or equity offering windows open or close. And the general industrial, I spoke a lot about private equity, but the general industrial firms have also been active. As they look across the landscape over the last several years and think about where do we want to put our money, the growth in the shale markets compared to the growth in the overall economy has been astounding. So we've seen a lot of the general industrial firms looking to get some of the action in energy. And this page shows some of the buyers and some of the sellers that we've seen in recent years. So as the North American markets have expanded, so has the energy service and equipment M&A activity in recent years. And this chart shows on a quarterly basis the global energy services and equipment M&A transactions since 2009. You can see there on the right that this has dropped considerably in the last couple of quarters. Q1 is almost done. Our calculations, it's 45. If you ask me, I would speculate that the next quarter is going to be lower. And in my opinion, probably at the bottom, if not then, maybe the next quarter. I think there's a lot of pent-up M&A demand. It takes time to fill the pipeline. There were a lot of deals, probably record backlog for us in the fall. A lot of those deals have been put on hold, and it takes some time to start filling the pipeline with deals that are more appropriate for the current environment. Stock-for-stock mergers, capital raises, companies getting together to get geographic diversification or other ways in which to make the company stronger. So those deals are coming. The holding period would also suggest that, and the lack of consolidation in the market all to us suggests a ton of activity coming, but it's probably going to get a little bit slower in terms of deal announcements before it gets better. The other thing I'd point out is our guys who compile this data are pretty good about including everything, and there's a lot of, in any one of these bars, a baseline of international small deals, engineering companies, companies less focused on the drill bit or the North American real volatile sectors. And I think if you screened out sort of a baseline out of here, you'd see a more rapid drop in recent months in the sort of what I'd call core North American service and equipment M&A market. As I mentioned, there's a lot of overcapacity right now, and we think that's going to spur a major consolidation. What this chart shows is the percentage concentration of the top 5 players in various global markets. This is on a global basis. So when you look at, for example, wireline logging, shown in red towards the left, 80% of the market is captured by the top 5 players globally. But we wanted to point out that there's over 100 North American land-focused service providers. So there is still a ton of opportunity for consolidation. And we've highlighted a couple other sectors there towards the right. Hydraulic fracturing, 65% globally held by the top 5 players, but more than 50 service providers focused on North America. They are going to have to combine, and there's a lot of discussion going on right now about how to combine, cut costs, get basin diversification, get customer diversification, that sort of thing. Just briefly, I know Jim's going to talk a lot about oil, but the fundamentals, I've heard people say, is this like the 80s? In our view, absolutely not. And I just put here some of the data around what things were like in 85 and what they're like in 2015. A whole lot less excess capacity today than there used to be. And where that excess capacity is today, most of it's in Saudi Arabia, and it's in a market that has been, where demand has been growing 1 million barrels a year for the preceding 5 years. Go back to 85, it was declining 1.6 million barrels per day per year in the preceding 4 years. It's just a very different situation. But how does this downturn compare to 2009? What I've laid out here is the historical and projected quarterly U.S. land rig count based on Simmons estimates for the gray there shown at the right. And what you can see here is the shape of the downturn and at least the near-term recovery, and who knows, but our best guess and our rig count projections is that it looks somewhat similar, albeit a bit more muted in the recovery than it was in 2009. But the 08 to 09 peak to trough quarterly rig count drop and the 08 to 09 year over year at 54 and 53% declines, pretty similar to what we saw in 14 to 15 on a peak to trough, as well as a 14 to 15 year over year. So it does feel a lot like 2009, but on the next page I will point out that there are some very, very significant differences between how the market feels right now compared to what 2009 was like. First, availability of capital is immense, as I alluded to with all these discussions of private equity. There's a ton of capital out there. The banks are a whole lot healthier, but they're still being cautious. A lot of them are exposed to some debt right now that maybe they had wished they had not placed last year. They are cautious, but they're a whole lot healthier than they were. Overall, the economy is quite a bit better, obviously, than it was in 2009. But I also emphasize that in terms of this market psychology, when we talk to buyers and sellers of energy service and equipment companies, the potential sellers remembered how quick the turnaround was in 2009. Nobody's selling for cash now that unless they absolutely have to, and they're doing the least offensive deal if they need to raise money or restructure debt that they can with the hope that things get better. And that's causing a fairly significant bid-ask right now, and that's what's causing that drop in M&A that I talked about before. And I would say that, where do we go from here? Hard to say. Very few saw this downturn coming, and I just make the point here of showing the EIA forecast. There's one of many that didn't get it right. If you go back to December 2013, EIA was projecting 2015 oil prices from $74 to $132 per barrel for 2015. Not surprisingly, it's a band around where the current price was at the time, a pretty wide band in my opinion. Yet we are at a point now where we're 25% below the low end, and we were even lower than that before, early in 2015. Just highlighting, it's not easy to predict these things. And one last point on that point is beware of the futures prices. There's a lot of people who point to that and say, well, this is what the futures curve says for a year out. What this chart is the amount that the actual spot price at the time on this chart exceeded or was less than the price predicted by the futures market 12 months earlier. So that high point there that I have the arrow to, the 12 months earlier, the futures prices were saying that oil was going to be $73 a barrel. On this date, WTI was 145. It was off by 72. And you can see there towards the right how far off the futures prices were a year ago compared to where they are now. These are big numbers, and just highlights the fact that Jim's got a very difficult job saying where things are going. And with that, I'll turn it over to Jim.